Who heard about Startup Genome before? And who hasn't heard about Startup Genome before? A few people. So it's worth to come. All right. OK, so I was asked to talk about why startups fail today. But before I want to talk about why startups fail, here we go. I want to honor you as the pioneers of tomorrow, and I'm really proud and I'm happy to be here and talking to you today. I think what is happening right now in the tech space, in the entrepreneurship space, all over the world is breathtaking, and the room of people here today are going to change the world more than, say, if I would be a room full of politicians at a political convention, or at a room full of CEOs of small and medium-sized businesses. The people who are here today are going to have a bigger impact on our world than anyone else. We're going through something that is called the big shift, or we call it, come on, an entrepreneur enlightenment that we see currently globally happening. There's a huge amount of startups popping up all over the world in places that we would have never imagined that we would have tech startups. By the way, can we be a little bit quiet? Can you sit down and close the doors? We see that this explosion of entrepreneurship has an incredible impact on our economy. We see that the vast majority of economic rejuvenation of economic growth, specifically in the US, but also in other countries around the world, that the vast majority of job growth comes from highly scalable startups, most of them being high-growth software companies today. There's also various hardware companies that are coming up. And we see that even though the vast majority of those companies are creating all the jobs in our economy today, still most of those companies fail. There's an incredible failure rate today, and probably most of the startups that you're working on today are going to fail. And that's what inspired us to work on the Startup Genome, which is essentially started off as a research. The clicker somehow doesn't seem to work properly. In Stanford, where we started looking at startups and tried to understand what makes them successful and what makes them fail. In the very beginning, we just started working with about 50 companies hands-on, sort of helping them in order to succeed. And then we step-by-step started to automate the recommendation process. We sort of moved forward in putting out more and more research. We went from initially 50 companies to 650 companies to 3,200 companies to then a fully automated application that we launched that is now used by more than 50,000 companies globally. It's sort of the first automated analyst, or sort of a virtual mentor for startups all around the world. You can check it out at startupcompass.com. And based on these data that we've been collecting from all these companies, we've had a lot of insights in terms of what makes startups successful and what makes them fail. Now, what we found is the very, very biggest hurdle that startups have, and the reason why they fail is uncertainty. This uncertainty leads to the companies essentially very efficiently, with a lot of energy, executing the unnecessary, which essentially means that companies do things that later on turn out to be irrelevant. And the reason why is not because founders are stupid, but just simply because they have a lack of visibility into the market and into their own processes. And the art of entrepreneurship in many ways is to be able to deal with this uncertainty and to be able to mitigate risk as much as possible. Even though you're taking a lot of risk, your major task is to then mitigate this risk as much as possible, as fast as possible. And we've seen that, or we've been able to explain the vast majority of the failure with the concept that we call premature scaling, which essentially is, if you're familiar with the lean startup, sort of a conceptualized version of the lean startup, where we compare the company's market validation with the operational activities. And what we see is that damn it. How can I go back? Yeah, all right. Sorry. And what we've seen is that the one key way of how you can overcome this uncertainty and how you can mitigate risk as much as possible is to learn. So really the major task as an entrepreneur for you is to be able to learn as fast as possible, as much as possible, especially from your customers, but from any stakeholder that is involved as you're building your company. And what we can see is that premature scaling is essentially based on you having assumptions of what you think is true, what you think is right about your customer, about your product, about your pricing, about your customer acquisition strategy, etc., that most of the time turn out to be incorrect. So we've built this conceptual framework, premature scaling, and you can see here sort of how we do the assessment. We look at sort of the startup as an organism interacting with the market. We look at the market validation, and then we look at the different dimensions of the company that are describing the operational activities with their customers, with their product, their team, their financials, and their business model. And what we see is the companies that scale prematurely sort of move beyond their market validation in those different dimensions. So it can be that you sort of spend too much money in customer acquisition. It can be that you over-engineer the product. It can be that you hire too many people. It can be that you raise too much money too early. Or it can be that you start to sort of get stuck with a business model too early. And sort of one of the classic examples of a company recently that has scaled prematurely enormously is Color. They were one of the many photo sharing apps that went live, and they were so certain that photo sharing is a big market, and they were right about it. The problem is that just knowing a market is not enough. However, they didn't care. They had an all-star team of amazing entrepreneurs who were leading the company. They hired 30 people. They raised more than $40 million. And they launched the photo sharing app at the royal wedding in London with TV advertisement, etc. Now, after this launch, they had in total a few hundred pictures that were taken. And any avid photographer knows that that's what you can take by yourself at an event like this. And what essentially happened is that the company eventually imploded. And the reason why was because they prematurely scaled, because they were so certain about their assumptions that the photo sharing space is big and that they know exactly how to tackle the space, that they built something that, in the end of the day, turned out to be not used, that turned out to be not relevant. And there's a lot of companies that do the same thing. I'm now just quickly going to go through a few graphs sort of showing the difference between the companies that scale prematurely and companies that scale properly. And what we can see is that generally, both companies evolve over time, and it doesn't mean that you necessarily fail if you scale prematurely, but typically the performance metrics are significantly different. So we see, for example, that companies that scale prematurely are never cross a certain amount of revenue. They also, as we can see here, tend to grow a lot faster in the beginning because they're very certain about their assumptions. They think that they know exactly what they're doing. They typically start spending a lot of resources and trying to grow. But then at some point, the companies that scale properly pass them and then start to grow much faster. And this is a logarithmic graph, so that's sort of the, if you would look at it as a normal graph, you would have the common hockey stick. But you see that there's a significant difference between the companies that scale properly and the companies that scale prematurely. Same thing on the valuation side. You can see the companies that scale prematurely tend to sort of, because they're so over certain when they start raising money initially, they have much higher valuations. They're much more sort of confident about what they're doing. But then later on, their valuations drop significantly and they sort of burn out. Same thing sort of here on the funding side. And that's it. I'll go into a few sort of examples of how you can find this out. But summing up sort of the few graphs that I've just shown now is that the reason why most startups fail is because of an incredible uncertainty that leads to the companies very efficiently executing the necessary, so doing things that later turn out to be irrelevant. And the way of how you can overcome this as a startup is to try to have a very fast feedback loop, to be to talk to your customers as much as possible, to try to control your metrics as much as possible, and to be very, very sort of humble and feedback driven about your business, and to be able to change your assumptions very quickly if necessary. Now, how can you identify premature scaling with yourself? One of the things that we've seen is that companies that scale prematurely tend to be companies that get fixed on their business model a lot, or specifically the revenue streams very, very early on. So instead of focusing on their key value proposition of what they actually want to achieve and how they sort of want to tackle a large audience of millions, maybe tens or hundreds of millions of people around the world, they too early start focusing on how they're going to make money with this. Now, as a result, they might be able to become profitable early on, but what we can typically see is that they start to limit their chances of growth significantly, and that's something we can also see specifically in Europe is more common than, say, in the Valley, where it's sort of the other extreme, where typically companies monetize very late, whereas in Europe, companies tend to be more sort of like on the ground and you start monetizing much earlier. As a result, they sort of get locked into a much smaller market and never get to become the next Facebook or the next Google because they start to limit themselves significantly. Another interesting observation that we made is that companies that tend to scale prematurely also tend to outsource a lot of their team early on. Everyone who's built products knows that that's typically leads to a lot of friction the more you outsource, especially in this early process of building a product. You have a lot of iterations, a lot of changes that you're going through, and the more you outsource, the more friction you create, and the slower you can implement new feedback, the slower you can sort of put the ideas that you get from your customers into the product. And that creates problems and it seems like tends to lead to the companies then scaling prematurely. Another sort of core difference that we've seen for companies, again, early on, so in the discovery mode is that companies that scale prematurely tend to focus on product development. They tend to focus on trying to build something tangible right away, rather than spending the time of going through sort of this usual entrepreneurial process of trying to understand the problem, trying to investigate the problem, trying to sort of build a connection to why they're actually doing something, or why they're working on the company that they're working on, instead just work on the product. And I'm sure a lot of you, and including myself, we've been at a moment where we just had this brilliant idea and we thought, this is going to change the world, and we just sort of skip over this this process of just going and talking to these people that we think that we will sell this product to, or that we will offer this product to, and as a result, we scale prematurely. We build something that later on very likely will turn out to be irrelevant. And I think that's actually a really, really important point, especially as there's lots of young people here that are working on new startups. Don't be afraid to go out there and to investigate markets and areas that are very uncommon for you. Don't feel afraid to go into industries that maybe no one of you has ever heard of, and try to learn what are their problems. And very likely, you will find a lot of problems that you can solve and that you can build big businesses around. So another sort of, in connection actually with the previous slide, another thing that we can see is that companies that scale prematurely tend to over-engineer the product significantly, so they tend to build lots more features than are really required. And every one of you who's been building a product knows this. You sort of have this idea of how the product should be looking like perfectly, and it's very hard to say no and to sort of cut away features that might not be really the most important ones. But this process is crucial in order to be able to have a fast feedback loop. So as you're building the product, try to minimize the features as much as possible and build something very lean and simple. Now, again, sort of going back, one of the things that we can see is that companies that scale prematurely over-evaluate themselves significantly, so they think they're already a billion-dollar company when they start off, even though they haven't validated anything and they haven't really gone through this feedback loop of knowing what they're worth. Also, companies that scale prematurely tend to spend a lot more money on customer acquisition very early on, again, because they feel like they know what they're doing, they feel like they're moving in the right direction, so they will start spending a lot of their, not just money, but also a lot of their energy on trying to create buzz, even though for most companies, you don't need a lot of customers to really test your product. Maybe you just need 50, 100, except you're a company that has strong network effects and it needs some critical mass. You don't need a lot of users to start off with. So it's actually not something that you should be really concerned about in the beginning. What you should be concerned about is that you get the right retention, that you get generally the right engagement of your users, so that you can truly say that you have built a product that is not just a nice to have, but it's a must have. A product that can truly become sort of the fundament of a large company. That's it. I have a few backup slides. We have a workshop at 5 p.m. at the Expat Center for 3 hours, where we're going to dive in a lot more in detail into a lot of the different statistics. I'm also going to talk a bit about startup ecosystems, comparing different ecosystems globally, and so showing advantages, disadvantages that can help you as entrepreneurs in deciding where you want to build your company, especially if you're sort of like early on, it might be worth considering to maybe not start your company in Vienna, but somewhere else. So that's what we're going to talk about, and then we'll do a few sort of office hours, so with companies, going to talk through their stats and do a feedback round. So you're welcome to join that. Now I have a few more minutes, so I can, let's see, go into, well, maybe before I go into this, are there any questions? Are there any questions about what I've been talking about? I can take maybe 1 or 2 questions.
Wait. We have this cool thing here called Catchbox by an amazing Finnish startup. And you can catch and talk. And if you talk, hold them like this, not too close. Yeah, that's fine.
Yeah.
Hello. We don't know about what is the Genome, what is the next step in your process?
You mean in terms of the product or the
product.
Okay, so, well, there's 2 things coming up very soon. One of them is a new report that we're going to publish at the end of this month, which has already been delayed a few times because it's been taking a lot longer than we expected. And there's going to be a new version of the Startup Compass, which is really going to take the product to the next level, and is essentially a completely new type of dashboard, like a decision dashboard, something that goes way beyond sort of the traditional analytics dashboards that we know, and hopefully will have a big impact on the startup ecosystem.
Yeah, you mentioned that getting customer feedback is one of the most important things that consistent startups do. Have you seen any, in your research, techniques that these guys are employing that are most beneficial for time?
Yeah, so it depends heavily in what stage you're in. I think very early on when you're going through discovery mode, it's just talking to people, right? As you're talking to people, you start to find certain a certain structure that allows you to maybe start building out little surveys that you can start sending out to more people. As you're moving on, you will be able to build the first product. With the first product, you will then start measuring, especially retention, engagement, a few other metrics, depending on your type of product, that will allow you to see whether people even want to use your product. And then as you're moving forward, it starts to become more and more complex in terms of what you're actually using in order to gather feedback. I think one of the key components that is always important is to have a personal connection to your customers. So, you always want to continue talking to your customers, and that's something that people start to forget about, and not just the sort of the biz dev or CEO of the company, but also the engineering team should have some connection to the customers. Yeah, and there's focus groups, there's all kinds of things that you can do, right? There's lots of tools, Olark, as a sort of constant chat with users. There's you can do WebEx sort of conferences, etc. Yeah. All right, I think we might have one more question, and then we need to finish.
Quick question, please, if there is any. Catch. Who? Fast. Catch. Quick.
Those spreads show how many startups fall in the blue category.
Say it again.
Those spreads you showed, you have 2 categories, the blue and red.
Yeah.
How many startups fall in the blue category?
Well, it depends. So there is a, it's about, say, 70 to 30. But again, this might vary in different ecosystems. It varies for different kind of companies. Some companies have much higher sort of risk potential than others. So it can vary significantly for different markets, different products, different types of companies, different ecosystems, etc. So, yeah. All right, that's it. Thanks for listening. would love to see some of you at the workshop. If you're interested, you can come and join us at the Expert Center at 5 p.m. There's in the side events or workshop or somewhere, there's a, it's listed there. It has a very long and weird name, I think with closing the gap between idea and something else. But that's where I will be. So I would love to see more of you, and thank you for listening and coming. Thanks.